Hello everyone, today I'm going to share with you about third point of our what is option topic, and this is trading operations with options. So I divided these few measure points. Of course you can find some more options, more types of operation, because it's very luxury world of different strategies and different approaches for trading. So to explain this, I am going to use position builder from Deribit exchange. So I will left in description of this video my referral link for signing up if you would like to create your account there. So it will cost nothing for you, but Deribit will get some rewards for mine, so for me. So let's take a look and let's get started from the buy of option, and then we get tour about hedge of position. So let's take initially about buy of option. So we have two types of options. If you remember from my previous video, it's call and put options. So let's take a look. For example, option with expiration date of 30th of September 2022, and let's for example take, okay, we have now BTC rate, BTC price is 23,800. so let's take closest one. Okay, for example, let's take call options 23,000 with expiration in September. So let's take one as amount and we will get something like this. We can switch between USD PNL and BTC PNL. Actually no one of them works as I suggest, but okay, let's take BTC because it's more it more looks like I would like. So we have the following option, call option boat construction. So we have red line as expiration time, expiration date results. In case if we get price at currently and at current strike as 23,000, so we get losses about option cost. Option cost is here, average price, market price, average price. This is price of our position. Market price is current price of option. So we will get some losses about the same average price which our position was done. So let's take a look and we can see it is absolutely the same. Oops, sorry. Absolutely the same amount here and here. Oh shit. And here. So today PNL we can track on the green line. So if we will get this scroll point and we will get future time to closer to our expiration date, and we can see how our PNL will change after some days will be elapsed. So, and at the end of the day, and at the expiration date, we will get PNL exactly the same like we have as a red line, which is expiration date PNL. So this is position is pure bought call position, and we basically take long position in underlying asset. Underlying asset is BTC. So if we expecting that price will go up, so yeah, we can buy it as pure uncovered call, because it provides the same like we would like to get if we buy BTC, exactly BTC or futures on BTC, but our losses are restricted by option premium we paid. So let's now buy put option. Strike is 23,000, put option, and let's turn off call option, and we get the same picture, but it is mirrored from the call buying position. So we have the same logic. I don't know, it's glitch of platform, because it should be smooth, okay, like this. And so our maximum loss is the same as option price, which is 0.0887 of BTC. So we can see it like P&L expiry max losses. So here and here, everywhere the same losses. And this position is actually reflects our short direction, if we suppose that BTC will fall down, and we would like to restrict our short position by some types of stop loss, which is premium, but we can get unlimited profit. Of course, it's not so highly growing up as pure futures if you sell, but in comparison we have no unrestricted losses, unlimited losses in case of shorting futures. And of course it's a low. Actually I would like to show you how futures works. For example, let's take long one future, okay, and let's switch off BTC, and I don't know why it looks like how it looks like, because it's very weird, because underlying asset should have like this chart, like this. So it's basically has delta 1 in case if you buy future, but we can see this delta is equal 0. Probably it's glitch of platform, of position builder. And if we will go down, because our delta is will be 1, so in case if we will get down $1, our P&L will be minus $1. In case if price will go up on $1, our P&L will be $1. Initially I tried to get understanding why I didn't plot the thing correctly, but at the end of the day I gave up and just created synthetic futures. So it looks like this. We have to buy call and sell put. So in this case, let's refresh, let's use USDT. In this case we will get correctly plotted delta, which is +1. Delta means strategy direction. So if you have long, you have 1 delta. If you have short, you have -1 delta. Let me show you. Let's reverse the construction. We have to buy 1 put. Here we can see put, bought, and sell 1 call. So we have -1 delta, and we got negative. We got synthetic futures. So let's take this as futures explanations, and we we just have covered buy operation, sell let it be on the latest explanation. Let's take a look about hedging the position, initial sense of options. Let's suggest that we buy futures as underlying asset. Oh, sorry, -1. Okay, we have the following situation. If price will go up, we will make the same money like price go up. But if price will go short, in opposite of our favor, we will get infinity losses. Actually, it will be restricted by margin call, but in our case we have incredible losses. So to hedge this, we just all we need is buy put options. Let me show how it looks like. Okay, let put options. For example, at the strike, after what we won't take any losses. For example, if we buy futures at $23,000, so let's suggest that on 22,000 we won't get more drawdown than 22,000, so we have to buy put at this strike the same amount we have of underlying asset. Underlying asset is 1, so we buy put, and here we are. We have, let's switch to BTC, we have limited losses. I don't know why to plot like this, because net position of delta will be 0 after 22,000. So probably it's glitch of platform. In USD you will see almost the same as I expected to get. So we get losses up to 22,000, and then we have no losses. Basically it should be, let me show, like this, I guess. Yeah, like this, probably like this. Basically put looks like clear boat put looks like this. So we have limited losses when price go up, and we have unlimited profit if price will go up. If price will go down, basically in our short direction favor. So let's return one more time. We have futures, which is underlying asset, for example, and we would like to hedge it after 22,000. Okay, something like this. So we should buy the same quantity of underlying asset, and we will get the synthetic call option. As you can see, it is almost the same. Not almost. I don't know why it plot like this. Okay, here's absolutely the same. So this is logic of hedging position, but let's take a look if we have short position on our futures. Let's create synthetic futures. Okay, we have short position with -1 delta, and we would like to hedge it, for example, after 25,000. So all what we have to do is buy call at 25,000 with the same amount. So we have bought call, okay, and we got the same basically it's synthetic put, and our position is hedged in case if price will go up, and we have relatively infinite potential profit. So I've just covered buy future or buy options, call and sell, call and put, and hedge the position. Let's take a look about sell of options. We have uncovered sell and covered sells. So let's take a look about what is uncovered sales and what is sales at all. Actually, inside option traders community there is saying that you don't must to sell, you can't sell your country, your mother, and uncovered options. Basically it means you shouldn't sell it if you don't understand how options works, how options work. So in case if you sell uncovered options, it means that you get some premium if price will go in your favor, and you probably can get infinity loss if price will go opposite your favor. So here is the illustration of this situation. We got premium and profit if price if price at the expiration date on this option will be less than 23,000 because we sell put. Oh, sorry, we sell call. And if we will sell put, especially put, because Bitcoin has increasing volatility in case if it will drop down, and it create additional requirements on your margin of position, support and margin of position. Okay, here is sold put. So basically it's long direction favor with restricted P&L profit and unlimited losses. So this is situation of selling uncovered calls and puts. Let's take a look what is covered call and puts. So basically all what you have to do is buy wait a second, here is example of sold at strike 23,000 call, and then we have to buy call at another strike on our loss direction. I don't know why it looks like this. It should be another, plotted another, probably because it's trying to okay, something like this. It's trying to recalculate in another profit of currency. Okay, so we sold call at $23,000. So we have profit if price will go below that strike. In case if price will go upper that strike, we will get losses. And to restrict our losses, we have to buy another call, for example, like this 25,000 strike at the same expiration, and so we will get limited losses, and it's fine. Of course, we can change delta of position. If you can see, we have currently 0.17 with minus. It means we have short favored position, and we can, for example, buy 1.5 of options. This construction of option construction is called as ratio spread, but let's take a look about equity line is P&L, and you can see of course it's will negative. Okay, let's take another ratio, for example, 1.3. Oh, okay, great. So in this case, we still will get some profit if price will go below our strike, initial sold strike, $23,000, and in case if price will go up, especially in few next days, look at green line, we have it positive, all-time positive, and if price will go up, for example, at $30,000, we will get the same profit as it was in short direction, and we have break-even point and expiration date as $30,400, and then all will be our profit. The major risk is at the both strike of hedged option, because if price will if expiration will be at this price, our call option, our bot call option will be at the money or out the money if slide below, and it means that premium was spent in vain, and this is price period between our strikes, bought and sold. So returning to this point, now you know why selling uncovered options is a very bad idea if you don't know how to manage, how to handle this position, and have no enough margin to support this position in case if you will sell option in volatility increasing direction. And let's take a look at the last point. It's options constructions. There are a lot of different options constructions. I just highlighted a few of them just to get to allow you to get some understanding. Synthetic derivatives, we already took a look in hedge of position explanation. Let's take a look about spreads. Basically spreads we also took a look because this is covering call sales, is spread situation, but this is a debit spread because we get some premium of this and are waiting to get price in our favor. But also we can use it is sold spread because we sell options with high price, and we can reverse this position, and for example we can buy this one and we can sell this one minus, oops, okay, here we are. Basically what we did, if we will not sell options, we can see that our maximum loss is 0.12 and 65 of BTC, but to reduce potential losses we fund it, or in other words we are going to fund it our buy operation of option. We can sell further strike option with the same type, for example 25,000. Actually it should be sold the same amount, but in this case we will get something like this, which is not actually corrected, but okay. To show you, actually currently I'm in searching of adequate adequate crypto options exchange, and Deribit is most good one I found, but not the best of the best. Also we have Delta exchange, but I'm currently passing verification there, so but it looks like on Delta exchange we have more correctly position builder. Okay. But not sure, we'll update you soon. Okay, here we have lower potential losses in case if expiration will be in negative zone, but also we have lower potential profit in case if position will expire in positive zone. So this is permanently compromising of our losses and potential profits. So this is spreads. The same looks like the same put spreads will look like. Okay, let's take a look about this spread. So I guess we have to. Okay, okay, let's take one. Very weird position builder. Very weird. Okay, 0.5. Okay, 0.4. Okay, something like this, 0.5. Actually, we have to get picture like this. Oops, let's plot from another side like this, because we totally hedge our position. So what we have in this situation, we have sold put here in case if price will go up. Basically in our long position we will earn premium as our profit. In case if price will go down, to limit our losses we have to buy put at another strike. In our example this is 22,000 strike. So after that our PNL will be equal 0. Our losses, our profit will be equal 0. Our losses will be hardly will be limited by this amount of loss. So this is how spread works, and we can do opposite way. Spread -1. Okay, let's take a look. Okay, so yeah, the same situation here. We have to do 0. Sorry. So, okay, something like this. But of course it should be like this. It should be plotted like this. So we have limited losses and limited profit. Limited profit and limited losses. So that's all for spreads, calendars, strangles, straddles. Okay, calendars, I guess. Okay, let me show you. Calendar basically means that we buy, for example, call with one expiration date and sell the call with the same strike but for another on another expiration date. For example, we bought 25,000 call at 30 of September and let's sell. Okay, let's sell closest 25 calls. Where is it? 25 calls, the same amount, -1. Okay, amount short. Okay. So here we are. We will get the following situation. In case if price will expire day 26th of August at the same strike as we shaped it 25,000 here. We will get some profit. Hope we'll get some profit. And in case if price will go up and down, we will get losses. Basically it is to trade volatility, because all options has implied volatility, historical and real volatility measure, and we will explain it in another videos. So here we have such construction. It is volatility trade construction, and it looks similar like sold strangle. Let me show you. Basically strangle, it doesn't matter. Of course you can buy calendar and you can sell calendar. -1 1, so you will get reversed picture. So in case if price will go this favor, at expiration you will get maximum loss. On the other side you will get guaranteed profit. Okay. This is looks like strangle, but strangle is created like using the same price but different options type. Here we have one option type is call, but we can take the same expiration area but two type of options, and we can both of them buy or we can both of them sell. It doesn't, I don't know why it, oh okay, looks like here it's correctly look. So we can see it very similar like calendar, but it's most of delta trading strategies, not volatility, because volatility, as you can see, the same on all options. Okay, we bought strangle and we sell strangle, so we have the same but reverse it. If in case we have butterfly construction, it just means the same strangle construction, bought or sold, but with covered edges, which is butterfly wings. Let me explain you how it looks. For example, we have to buy our put direction, double, wait a second, oh sorry, it should be created like spread, and let me check, let's do, okay, on puts, okay, 20 and okay 20, let's do like, let's do like 20, okay, 30, okay, hop. Okay, here is butterfly. Of course it has some skewness. Okay, it's classic. I don't know why. Sometimes it's okay with BTC PNL, sometimes it's with USD. I have no idea. So here is butterfly or strangle with butterfly with hedged edges. So how it looks like. Also we can actually play with the amount of our wing side, and this way we can, for example buy this and wait a second. For example, here if our favor is short direction, we can shape something like this. Basically, we change our wings skewness, and this is how it will work. Okay, basically we can also buy some call here, and we will get some huge construction, okay, like this. Okay, here is example. As you can see, we have almostly delta neutral strategy, so it doesn't matter to what direction price will go up, we can get some benefits if volatility will change, but it's not a good example because volatility is almost the same with all assets. So let's return into Straddle. Straddle is basically looks like the strangle, but we use different strikes. Let me clean up. Okay, let's buy put. Okay, call, it was correct. Okay, here is straddle. We have both, actually it should be almostly similar on expiration date, probably something like this, but a little bit okay, let be like this. So in case if we have both straddle, we have flat range of losses and with forecast price growing up after some strikes. So basically it looks like straddle, strangle, or it looks like a strangle, but with two peaks instead one of in strangle. So okay, let's sell it, and we have the same but reversed. Of course we can buy edges and hedge our unlimited losses. So that's all for now. See you in next video. Bye bye.